guys, JC Parets here of StockCharts.com, and I have a special treat for you today. We're going to talk about two things: market breadth and market sentiment, and how it plays a role in the current market environment. So the first thing I want to talk about is market breadth. What exactly is that? The way I like to look at it is that, sure, it's a stock market. What did the Dow do today? Or what did the S&P do? And we can trade those things, right? S&P futures, NASDAQ futures, like they are tradable as a market. But at the end of the day, it is a market of stocks. There are approximately 500 stocks in the S&P 500. There are 30 in the Dow Jones Industrial Average. There are 3,000 stocks in the Russell 3000. That represents approximately 98% of all investable assets in the US equities market. It's a market of stocks. For the indexes to go up, you need more and more stocks participating to the upside, more and more sectors participating to the upside. When you think globally, you want to see more and more countries participating to the upside and making new highs. And we're simply not seeing any of that. And we'll get into that. When it comes to sentiment, there's nothing wrong with overwhelming bullish sentiment. You need bulls to drive stock prices higher. So that's perfectly normal. However, when there is a lack of bears, when there's just nobody bearish, the market has a funny way of creating a bunch of bears. And again, that's the current market environment that we're in. So to be clear, in many cases, market breadth might be noisy and might not be giving us a signal. In a lot of cases, market sentiment can also be very noisy. In fact, I'd argue it usually is, except at extremes. And that's the current market environment that we're in. Breadth is giving us information, and so is sentiment. So let's dive right in. The first thing I want to reiterate is just this is a classic year two market environment, right? Last year was a huge, tremendous year off of the COVID lows in late March. Classic year one thrust. It reminds me of a lot of that 2009 bullish thrust. And then what happened in year two? In 2010, after that 09 low, it was chop, chop, chop. We saw the same thing in 2004 after that initial thrust in 2003. And then, of course, I was born in 1982. Stock market bottomed. Maybe that was a coincidence, maybe not. But we can all agree it was a major thrust off that 82 low. And then what happened in 83 going into 84? Chop, chop, chop. And we saw the same thing off the 74 low after a monster year in 1975, and then 76 was chop, chop, chop. So this is classic behavior for year two of cycles. So when we look at the small cap Russell 2000 and micro caps, what does this look like? It looks a lot like these other ones, right? So I think the small caps are really telling the story. And to be clear, if the market wasn't messy for most of this year, that would be incredibly unusual. But that's exactly what we've been seeing, a messy market, which is perfectly normal for year two of a market cycle. When you zoom in and look at the monthly candles for small caps, these are the daily charts, right? So you can really see that churn over the last 4 months. And then when you look at the monthly candles, I mean, look at what a mess. Sure, technically they've gone up 4 months in a row, but have they? You know, when you zoom out and look at the daily charts, they clearly have not gone anywhere. Just chop, chop, chop. Meanwhile, I think it's important to understand what the value line indexes are doing. And I want to touch on these quickly because the value line indexes, I don't know why, but they don't get a lot of love. Me personally, and if you talk to the old school guys, they'll tell you too, the value line indexes are really important because it represents more of the median stock. So the headline might say, hey, new all-time highs in the S&P 500. What they won't tell you is that there aren't any stocks in the S&P 500 still making new highs, or very few of them, to be clear. And the value line index represents the median stock. So we're looking at the arithmetic and geometric scale. I encourage you to go look up the formulas for you math nerds out there. I know I've looked it up plenty. For me, I'm more interested in the conclusions that we can make based on the price behavior. So let's dive back in. Okay, so what we're seeing here is the value line geometric index up top and the value line arithmetic index down below. And what are we seeing? With new highs in the S&P 500 last week, lower highs in the value line indexes, showing you that the median stock out there in the market is simply not participating with some of these mega cap driven indexes. What are we also not seeing? We're not seeing any new highs, right? The journalists are very quick to tell you that the S&P 500 or the Dow or the NASDAQ is closing at new all-time highs. But what the journalists will conveniently leave out for you is that there just aren't any stocks making new highs. When you look at the New York Stock Exchange list, again, common stocks only, we're getting a deterioration in new highs. The NASDAQ has been deteriorating in new highs going back to February. So that's not anything new, just a lack of new highs or a lack of breadth. And just when you thought things couldn't get worse, what have we seen from the advanced decline line? Here we're looking at the New York Stock Exchange common stocks advanced decline line. And I want to touch on this for just 1 second because the New York Stock Exchange has a lot of things that aren't stocks, closed-end funds and bond proxies that can skew the data. So if we're wondering what stocks are doing, we want to look at the common stocks only list on the New York Stock Exchange. So that's my one caveat there. And what are we seeing? With new highs in the S&P 500, we are getting a lower high in the advanced decline line. Now, one thing I'd like to reiterate about the advanced decline line is that not every peak in the market is preceded by a lower high in the advanced decline line. However, if you have a lower high in the advanced decline line and you get a bearish divergence, you really should pay attention. We saw the same thing right before the COVID crash, right? New highs into February of 2020, and then lower highs in the advanced decline line, and then one of the greatest crashes of all time, right? That was terrific. We were hoping for it, we were short, we were buying bonds, and the advanced decline line was a great heads up that something bad was about to happen. We're seeing the same thing in the NASDAQ, but in this case, we saw that peak in early February. So it's really nothing new that the NASDAQ advanced decline line has continued to deteriorate. And again, we saw the same thing right before the COVID crash, new highs into February in the NASDAQ, lower highs in the advanced decline line, and one of the greatest crashes of all time, right? So if you were watching the advanced decline line, it was a great heads up, and I also think it's a great heads up today. So this chart is 2 months old. Just want to show you really the Dow Jones Industrial Average hitting our upside objectives based on these Fibonacci extensions, and our targets were hit back in May. So I think my blog post was cash and champagne or something like that, or drink champagne and go to cash, something along those lines. We like to have fun with this, but our targets were hit. It was time to feed the ducks, get out of the way, and now the market is somebody else's problem. Fast forward a couple of months later, and what has the Dow done? Just really churned sideways. So feeding the ducks a couple of months ago worked out to our advantage, and I think it continues to be. I don't see any reason to rush into the market until we get a breakout, and we certainly have not seen that. The second most important stock market index in the world is the Dow Jones Transportation Average. You can fight me on that if you want, but I'm telling you, the most important stock market indexes in the world are the Dow Jones Industrial Average #1 and the Dow Transports #2. The great Ralph Acampora taught me, don't fight Papa Dow. And whenever I have fought Papa Dow, I have regretted it. So that's not something we want to do. So a couple of months ago, the Dow Transports also hit our upside objectives, literally the exact same Fibonacci extension level off of those 2018 highs. Time to feed the ducks, mission accomplished. I believe the transports were up 14 consecutive weeks. So a break was not only justified and well-deserved, but most likely would happen at a very logical level. So it was time to feed the ducks. And if you fast forward a couple of months later, what has happened? Not only have we turned sideways like the Dow Industrials, we've actually sold off. So now the transports, which were former leaders, are now the laggards. Now let's talk about market sentiment. Market sentiment is really, really important. Because what we're doing is that we're analyzing the behavior of market participants, right? So we can see that in the price action. A CEO might be lying to you or just wrong, right? Sell-side analysts have their own biases. Again, they could be lying to you or wrong. They start their work with incomplete and incorrect information, so they're destined to be wrong, right? The government reports that come out, unemployment and GDP and all that stuff, those are just estimates. Those are human estimates or robots built by humans. And they tell you ahead of time that they're going to adjust it a whole bunch of times over the coming 6 to 12 months. So we can use that data if you want, or we can analyze price behavior. And the one thing we know about price is that it's the truth, right? It will never be restated. If a stock is traded on a given day, there is a buyer and a seller at a specific time, at a specific price, at a specific second in time that's never going to be restated. Price is never restated. Earnings are, government estimates, all those things are restated. Price never is. Price is fact. Price is the only truth. So if that's the case, we want to analyze that market behavior, but at the same time, we want to analyze the humans behind that, the fear and the greed driving those markets. Because sure, markets have evolved. We have the decimalization of stocks. We have new asset classes like cryptocurrencies. But the one thing that remains constant is you and me, and we're crazy in between the ears when there's money involved. Fear and greed are driving these prices. So not only do we want to analyze prices, and to be clear, that's number one, number two, number three, number four, number five. Those are the most important things. Price, right? And then far down, far down, we want to analyze sentiment, again, as a supplement to that price analysis. So here what we're doing is that we are combining the II data, which polls financial advisors, and the AAII data, which polls individual investors. And we're combining both polls to create an average. And what do we see? We see, well, I'll tell you what we don't see. We don't see any bears, right? There's just nobody is bearish. There are the fewest amount of bears since early 2018. And for you history majors out there, if you recall what happened in January of 2018, stocks all over the world peaked and they stopped going up and they started going down for years to come. We're at the same levels we were then. There are no bears. And when there's no one's bearish, the market has a funny way of creating new bears, usually through a price correction. Meanwhile, the old saying, don't worry about what they say, worry about what they do, right? Don't look at their lips, look at their footsteps, right? Is what they say, all these old sayings. So what I really like about this poll is the National Association of Active Investment Managers. So these are people who are actually putting money to work, and they poll them in terms of what they're doing. These are active managers, not passive investors who are just buying and hoping, right? There's buy and hold, and really what buy and hold is buy and hope. So these are active managers, people actually managing risk, people looking to put risk on. And what I see is with each new high in the NASDAQ and the market overall, there is a less of a thrust, less aggressive buying and participation and positioning with each new high. Weaker and weaker hands, not stronger hands, which is perfectly normal considering what all the other charts. I mean, doesn't this look like the advanced decline line? Doesn't this look like the value line indexes? Doesn't this look like the new 52-week high list, right? Deterioration, deterioration, deterioration. And of course, if you know me at all at this point, we can't have a conversation about the stock market without also having a conversation about the bond market. So I want to talk about this for a second because it has nothing to do with COVID or economic stimulus or earnings. Forget about all that. What drives markets is liquidity. You can see it in credit, right? So if money is being put to work, it's being aggressive, money's easy to get, you're going to see those credit spreads narrowing, right? Those are characteristics of risk appetite, risk on environments, if you will. However, if there's a problem in the market, if there's a storm brewing, you're going to see it in credit spreads. Credit spreads are going to be widening out. The spreads between German and Spanish bonds, the spreads between US junk bonds and US Treasury bonds, for example. Those are credit spreads, and they tend to widen out when there is stress in the market. So if you don't see them widening out, there likely is no stress in the market. But when you do, that's when you want to pay attention. Kind of like the advanced decline line. So what do we see? We're looking at a ratio in black between junk bonds in the United States and US Treasury bonds, right? So as the S&P 500 was going up, notice how the ratio was going up also. Bond investors were more aggressively buying junk bonds than they were Treasury bonds. That's evidence of risk appetite, which we were also seeing in the stock market. They were trading tick for tick, which is perfectly normal in the case of uptrends. But then what's happened over the last several months? New highs in the S&P and the NASDAQ. However, lower highs in the ratio between junk bonds and US Treasury bonds. These are credit spreads widening. This is evidence of stress in the market. Again, not confirming what we're seeing in the stock market. And then, when you really think about it, the fact that Treasury bonds have been going up, which we'll get into in a minute, why are Treasury bonds going up if there's real inflation out there? They should be doing the exact opposite. So clearly, they don't teach bond market analysis in journalism school. Or maybe they just ignore it. I don't know. Let's talk about Dow Theory. Okay. And what's interesting about Dow Theory is that this goes back to the 1880s. A journalist, speaking of a journalist, by the name of Charles Henry Dow. And Charlie Dow just wanted to see what was going on in the economy, was trying to figure out, whether things were getting better or getting worse. So he was in Springfield, Massachusetts, and he'd go knocking on doors, and he'd ask, CEOs of companies and want to ask them questions. And you know what the CEOs would say? They say, our business is none of your business, which is hilarious looking back on it. So Charlie's like, well, what am I going to do? So what Charlie did is that he created two indexes. He created the industrial average, which are the companies that make the goods, and then the railroad average, which are the companies that deliver those goods. And he said, if they're both going up together, then things are good. If they're both going down together, then things are bad. And if one's going up and the other one's already rolling over, that's a heads up that things are changing. Ultimately, they were changed. The Dow Jones part was added to Charlie's industrial and railroad average. And also down the road, it was changed to the transportation average because, of course, we had other things other than railroads like airplanes and automobiles and things of that nature. So with that being said, when my friends and I get together, at a bar late night, what are the things we talk about? We talk about Dow Theory. We can't help ourselves. And the thought process is, well, when Charlie Dow was around in the 1880s, sure, railroads were the method of delivering those goods. But is that what's used today to deliver the goods and services? No, we do it through computers. So semiconductors are probably a better gauge of whether or not those goods and services are being delivered or not. So I don't know which one the answer is. So what we do is that we include all of them. And here's that chart. So here we're looking at the Dow transports making lower highs. We're looking at the Dow Jones Industrial Average basically flat for a few months, while semis are making new highs. So in the modern Dow Theory analysis that we do, there's a divergence in the transports. Semis are saying everything's fine, but the transports are saying that something is wrong, which we're seeing a lot, by the way. It's a common theme because there is no one indicator, right? It's a weight of the evidence approach. So what are we seeing with the S&P 500 making new highs? Well, the equally weighted S&P 500 is not making new highs. So this is suggesting that a few of the mega cap names are driving this index. And as we saw on the list of new highs or lack thereof, what we saw in the median stock, which is the value line index, not seeing new highs. What are we seeing in the equally weighted index of the S&P 500? Another divergence. Divergence City, baby. This chart is really interesting because it really shows the stealth correction that we're seeing under the surface. With the S&P 500 making new highs, look at the average drawdown from new 52-week highs inside of the S&P 500. Remember, this is a market of stocks. We saw similar deterioration right before the COVID crash, right? We're seeing the same thing now, that stealth correction taking place underneath the surface. And then some of the other intermarket relationships that we look at, particularly Aussie yen, Australian dollar, known for their commodities exports in China and more of a risk-on gauge in the currency market. And the Japanese yen is the most, or one of the most defensive currencies. You got the US dollar and Japanese yen is the most defensive. So when you're looking at Aussie yen not making new highs, there's another divergence to add to the list. When you look at the ratio between high beta stocks and low volatility stocks, it has been a beta chase since the beginning when the market bottomed last year. High beta outperformed the whole time. Well, guess what? That has changed as well. So, when you talk about Divergence City, it's not one magic indicator. It's not just one chart. It's all of them combined. And then what just happened this week after the 4th of July weekend, we came in and the US 10-year yield lost its 1.4%. right? And what did we say? This was support in 2012, support in 2016, support in 2019. We broke in COVID, right? This was one of the big reasons why we're bearish stocks, because we figured if rates were collapsing, how's the stock market probably doing in that environment? My bet was probably not that great. So sure enough, that was correct. And then notice how rates were ripping while stocks were doing well. So if the US 10-year yield can't hold 1.4, I mean, we know now that it didn't, but what the thought process was, if it can't hold that, then there's a problem, right? Maybe that's why bonds keep going up. Maybe that's why we're seeing all these divergences all over the market. And sure enough, we came in after the 4th of July weekend, and sure enough, that 1.4% was broken. And Treasury bonds are up 3 months in a row. So the journalists keep telling you that inflation's here, inflation, and the bond market is like laughing at those journalists, right? Because if there was real inflation, bonds would not be going up. Interest rates would be going up. And the exact opposite is taking place. So do you want to trust the journalists or do you want to trust the bond market? To me, it's quite obvious. I'd rather place my chips with what the bond market is suggesting. And regional banks are breaking down to 5-month lows. And what do we know about regional banks? We know that they do, they tend to do well in an environment that the market thinks that rates are going up, right? And if the market thinks that rates are going down, regional banks are probably going to underperform, right? That's historically the correlation. And that's exactly what's going on now. So sure, we came into the week with regional banks making 5-month lows, but the US 10-year yield had yet to break 1.4%. So now in hindsight, the regional banks were already telling us that something was wrong, right? And now we're getting the break in yields. If you want to take that thought process one step further, here we're looking at regional banks versus REITs, putting in a massive top. When the market thinks rates are going up, you're going to get a sympathy bid in regional banks. However, when the market thinks rates are going down, you're going to get a sympathy bid in REITs because those fixed income investors are not able to get their yield in the bond market. So you're going to get that relative bid in the stock market in higher dividend paying stocks. And REITs are right at the top of that list, which is why the regional banks versus REITs ratio looks exactly like the US 10-year yield. So a top here, top there makes perfect sense when it happens simultaneously. So here's the trade. I mean, if regional banks are below those 2018 highs, this creates a failed breakout. Here's your bearish divergence in case you didn't have enough of them. And if regional banks are below those 2018 highs, we can be aggressively short the banking stocks. I have no problem with that at all. In fact, it's been our favorite short since last week. And look at the financials, where are they correcting? At a perfectly logical place, at the 161.8% extension of the entire 2018 to 2020 decline. So this, the weakness that we're seeing in banks in general is coming at a perfectly logical place. So even if you didn't look at the sentiment, if you didn't look at market breadth, if you ignored all those other divergences and you just stuck with this chart, you would have also been right. So I think maybe we head back down towards that 30-31 level. And by the way, this is the options trade we put on last week. It's the November 34 puts. They were going for approximately 88 cents or so. That's where we got in. And, the idea was if the market is, if the bond market is telling us that stocks are about to get hit, right, this is probably one of the better ways to take advantage of a decline in stocks is financials, right? High correlation to equities, already showing relative weakness, our upside objectives hit, etc., etc. I had to show you guys this chart because this one comes from a few months back when I'm looking at these consolidations, right? So they teach you in the book, if you will, that continuation patterns, similar to these symmetrical triangles, should resolve in the direction of the underlying trend. But my question was, what if they don't? What if these patterns do not resolve in the direction of the underlying trend? And that's precisely what happened. They did not. So that's the signal. So it's not that technical analysis didn't work. Maybe your technical analysis didn't work, but when these quote unquote continuation patterns do not resolve in the direction of the underlying trend, that, my friends, is the signal. Meanwhile, Goldman Sachs, and by the way, this was materials and financial, so we're seeing the exact same thing in both areas. And then look at Goldman Sachs has been a huge winner for us this year, and our upside objectives were hit, right? It's a 161.8% extension of the entire 10-year base. Price targets hit, feed the ducks. Now it's somebody else's problem, right? And then again, I want it to be clear that the long-term trends have not changed, okay? The long-term trends are still in place. This is still a 14-year breakout, but that doesn't mean that things can't be messy for the next several months. In fact, our bet is that things continue to be messy for the next several months, but I think it's important to put things in context, bigger picture, which is part of the whole year two, right? If this was year one, big time breakout, year two is a mess, and then we can continue and make new highs. But we're in a mess now, so we need to worry about the market that's in front of us. And when you look at these monthly candlesticks, I got to tell you, these outside months are incredibly rare. And for me, these monthly candlestick charts every month is like a religious experience, right? I go through them every single month, probably more than, almost anybody else in the world. And I could tell you from experience, these outside months are incredibly rare and bearish for that matter. And then where is that happening? European banks are failing at exactly that 20 level, which has served as resistance over the last couple of years. So if European banks are below 20, first of all, our financial shorts are probably doing pretty well. Rates are probably going lower, and stocks in general, not just in the United States, but globally, are probably under pressure. And that's exactly what we're seeing. Now look at European banks relative to the rest of Europe holding below resistance. This is a hot mess, folks. So until we break out above these levels, it's really hard to give them the benefit of the doubt. European banks are guilty until proven innocent. And then I want to show you this risk on, risk off checklist. For me, it's fantastic, to give you an idea of the types of things that we're doing here behind the scenes. We're looking at consumer staples on a relative basis, important sectors like semiconductors and regional banks, commodities like crude oil. We're looking at fixed income markets, the junk bonds that we looked at before. We're looking at the currency markets like Aussie yen. So there's a whole slew of them, and the number on the risk on territory continues to deteriorate, in case you hadn't seen enough deterioration up to now. So what do we do about this market? Well, one of the things that we like to do is follow the flow, right? Because regardless of what's happening in the macro environment, if there are big players trying to be positioned in a particular name, you're going to see it in the options market. So what we do is every week we isolate the biggest splashes, if you will. And by splashes, we mean very aggressive directional bets in the options market, whether it be bullish bets or bearish bets, right? We've seen a lot of put activity and bearish activity in the NASDAQ, not just bearish activity in the NASDAQ itself, but bullish activity in the inverse NASDAQ ETFs. And we're seeing a lot of bearish activity in general, which really confirms what we're seeing elsewhere. But to be clear, we're looking at usually individual names. Sure, some ETFs come up on the scan, and that's cool too. That's good information. But particularly, we're focused on the names, stocks and ETFs, where there is very large, very aggressive institutional bets being made directionally. Again, either bearish or bullish. So this is this week's scan, showing the red ones are the bearish activity, the green ones are the bullish activity. And one of the names that stood out, we saw a ton of activity on the 20 calls. This was on July the 6th. These were the July 16, 20 calls. So we've wanted to be long skin, SKIN. This is the beauty health company, SKIN. And if it's above 18, we want to be long with a target of 30. We want to be long skin if we're above 18 with a target of 30. If we're below 18, then we do not want to be long. Because again, remember, just because these massive institutions are very aggressively positioned doesn't mean we want to. We want to be selfish and manage our own risk, right? And that's what we do here with 18. We also have another great scan. This is the minor leaguers. So these are small caps between $1 and $2 billion specifically before they quote unquote get called up to the mids, which is above $2 billion in market cap. They become mid caps. So really, really interesting scan. And remember, the small cap names have much less correlation with the overall macro environment than, say, some of the mega cap names that get, tied in with all the global macro. The smaller names can get knocked around by these institutions a lot more. And remember what the Russell 2000 has been doing the last 4 or 5 months. It's been a big nothing burger. Absolutely nothing in small caps. So we want to sort them by proximity to new highs, meaning showing relative strength and bucking this overall bearish trend. And Zoomies really stands out. And to be clear, we are currently, as I'm recording this, not above 52 in Zoomies. We are currently below it. So we want to be patient with this one. It's a $1.3 billion retail stock. It's funny, I was joking. I didn't realize they were still around. But what really stands out is this massive base, right? So we only want to be long zoomies if it's above 52. To be clear, currently it is not. So we want to be patient with this. Just because it comes out on the minor leaguers report doesn't mean we just want to dive in. Quite the opposite. In many cases, we're just watching, observing, and then we'll buy the breakout, in this case, above 52. So if you're interested in these slides, please email info@allstarcharts.com. Make sure to use the password bad breath. I can't emphasize it enough. Make sure to use the password bad breath so that you get the right deck. info@allstarcharts.com. Password bad breath. Ladies and gentlemen, I am JC Parets. I was your host today. If you have any questions, shoot me an email. Say what's up on the interwebs at AllStarCharts on Twitter, StockTwits, Instagram, YouTube, and Clubhouse. Thanks, guys.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.